All right, so what's happening? Well, let's just kind of go through the table of contents here. And like I said, we're going to talk about the recent funding, what the allocations look like. I think there's a lot of interest and discussion that we'll focus on in terms of what's going on with the redetermination process for phase 3, and there's going to be a redetermination process for phase 4. And so I think it's a good discussion just to to make sure folks are comfortable with the amount of funding that either has been allotted to your hospitals or that has not, right? And being able to understand, well, whether or not a person made the right decision on those funding amounts. And then we'll go through some hypothetical scenarios of provider relief reporting because, we're in reporting period 2. I mean, one of the interesting things about this reporting period is a lot of the funds that we're going to be reporting on due March 31st are going to be targeted payments. And if you're a part of like a healthcare system or you have a parent subsidiary relationship, it's important to understand, well, what are the mechanics of that, considering that the targeted funds are really supposed to stay within the tin, but you can transfer. And so we'll kind of go through examples of that and talk about what resources are currently available as well. So today's news, right? I mean, you're not, it's not a dull moment in the Provider Relief Fund unless there's some breaking news, at least especially as we kind of come out of the holidays and back into, operations for the 2022 year that we're in. So today, the news that came out, and I got this through the HFMA, they're really good about having, chat channels available and things. And so HRSA announced it's going to start to audit, and they've said this too in the compliance addendum, in terms of what they're looking for compliance on a lot of the single audit type of things. There's going to be a focus on this out of network deal, right? Where, you're basically not supposed to, or as a recipient of PRF, right, for any COVID-19 patient that comes through your hospital, that they basically are billed at usual and customary charges and not done in any sort of balance bill or out of network method. So that's all starting, and we're certainly going to learn more about it as more information comes out. But the announcement came out from HHS today saying, look, we're going to start to think about how we're going to do this. They say that the expected issue date, I guess that's related to the reporting requirements or whatever audit protocol they're setting up. They say 2023, so we'll see what that means. I'm not entirely sure. But what I have been told, and I was on a call this morning with some really smart people, and one of the things that was being discussed was, well, hey, this is all well and good that they want to audit this, but providers might not have a system to say, here's this population of claims that you might want to look at, or here's the population of my COVID patients that were not in network with a particular payer and the provider. And so I just think that that's something to think about, right? As we all kind of gear up for these audits, how, do you have the ability to produce a list of those patients? If not, I think that's something that should be communicated throughout the industry so that we can all set and manage the expectations of what's about to happen with these audits. And maybe we could help develop whatever that criteria needs to be to help find who these patients are. So that is today's news. And so there's a link down here, and absolutely we'll make this presentation available to you as well, so that you can click around and all that. Okay, so the other real hot button issue, or one of the other hot button issues with the Provider Relief Fund, is like, okay, so we've had a lot of funding allocations. I mean, this has been going on, for almost 2 years, and there's been a lot of announcements about the amounts appropriated and the amounts out of the appropriated amounts. There's actually, HRSA will tell you how much has been allocated to providers, but it's still not the most transparent thing, right? And well, I'll talk about, there's a slide that we've added since Tuesday about this report from this news agency Stat that talks about the lack of transparency and some of the dipping that might be going on in the funds. But what we are able to see is that, we know that between the CARES Fund and other sources of funding that are used for the provider relief, such as amounts that were appropriated in the Consolidated Appropriations Act, there is $186.5 billion available to hospitals in our current status of funding. Out of that amount, right, what's been told to us is that 170 billion has been appropriated, meaning that as they are carving out targeted and general distributions, that these are the amounts that have been set aside for providers as eligible potential payments. However, the amount that's actually been allocated out of those funds, meaning that HRSA has an expectation that it's going to providers, whether or not I'll say they've attested to it, because if you look at the amount that's been attested to on the TAGS website, it says like 122 billion, I think. But if you look at other pages of the PRF HRSA site, they say, they itemize the amount that's been allocated out of each of these funds. So when you tally all that together, there's been 143 billion, which leaves, right, if you look at the amount available to hospitals versus the amount that's been allocated, there's $43 million as left over before we start thinking about everything else. And so, as we kind of, and again, we'll talk about why this is important. I mean, it's obvious that, this exercise is important because we need to understand how much is left over. And as we're looking to for more relief, right, how much is left over in the current fund versus, if there's a request such as the AHA has a request for 25 billion, how much more could we potentially ask for? But going back to this, right, so if you look at the amount available versus the amount allocated, it's we calculated about 43 billion. I find it interesting, right? If you look at general phase 2 as an example, right, they set aside 18 billion. And this is largely for, remember, phase 2 was for providers that were predominantly Medicaid and not a part of some of the initial phase 1 distributions due to, I guess, not being enrolled in Medicare as much. And so there's a 12.9 million, but there's not a lot of discussion. What happened to that 12.9 million, right? So perhaps, and I don't know for sure, but one of the things is, as we're looking at the amount of funding, well, we have HRSA's uninsured fund, right? And that has been going up. I mean, now I think I looked at this over the weekend and it was at 17.2 billion. But a few months ago, this thing was at, I want to say 7 billion, right? And so it's exponentially increasing. And that's something that's not really being budgeted for, right? That's an open fund, and there, HRSA hasn't said and put parameters on how much that spend will be. So that's going to come out of the residual, right? It's going to come out of this 43 million. Then we have what happened with Operation Warp Speed, right? And if you recall there, money was taken out, right, to help with the development of vaccinations and speed that up as quickly as possible to get people vaccinated, which is great. But it did come out of the Provider Relief Fund, $10 billion. And so the question becomes, and this is what's in this article that's very recent, is we're going to get that back, right? Is that going to go back to hospitals? Because the way that HRSA responds is, well, it's still used for treating COVID patients because it has to do with vaccine, right? But it didn't, technically didn't kind of go through the path of the Provider Relief Fund to providers as it was expected. So the question that remains is that $10 billion coming back to us for provider in the form of provider relief funding? The other thing that's mentioned in the stat article is, and it's not included in this reconciliation, but I denoted it, is it appears that there's another 7 billion that was taken out of the fund for vaccination purposes, right? And so the same question with that, do we get that back, or what's the relationship with the residual and the money that's being pulled out? The other things that are going on is, right, we have to reallocate, or not reallocate, but there's still the remaining spend, I'll call it, a phase 4. So there's about $6.3 million of phase 4 funding. We'll talk about, right, some of the recent allocations of phase 4, because that's news from this week. $2 billion went out. Then there's still 3.41 billion of phase 3 remaining. And we, a lot of folks on the call might know and perhaps be a part of reconsideration. So I'm not sure if the entire 3 billion would be spent as HRSA considers providers that are looking for a reconsideration of their phase 3 application. But that would, the amount that they have to spend is 3 billion there. And then there's some more left over from the rural funds from the American Rescue Plan Act. As we talk about the redeterminations that providers might be eligible for between phase 3, or I'm sorry, between phase 4, its bonus payments and the American Rescue Plan funding for rural providers. Remember, a lot of that stuff is based on claims. And so it's an interesting concept that providers are able to challenge that. And I would imagine that any provider that wanted to challenge the claims that were used for any of these bonus payments would certainly have a case, because we know that claims data isn't always very accurate, especially when it's coming from Medicaid managed care payers and things like that. So where we're at is, if we've calculated about, with all this considered, again, one of the big caveats is that this 12 million is given back in some form out of phase 2, that this 10 billion is given back. That would bring us at about $20 billion in remaining funds. However, with the stat article that came out, and again, there's a link here, this came out just a couple days ago. Again, this article references and basically saying, hey, look, we remember that 10 billion was taken out, right? What's going on there? We've just found out that another 7 billion has been taken out for COVID-19 vaccinations and therapy. And so that's a total of 17 billion. And so what HRSA responds to, according to the article, is, well, some of that 17 billion was, attributed to providers that return their funds, right? Because that's another pool of funding that's still out there. But again, there's not a lot of transparency or reconciliation in terms of how much is really left. This article does say, let's see, the provider relief fund has run dry, right? Ooh, I'm sorry about that. And so, I mean, that's a really bold statement. And I think if you were to do math a certain way, you could certainly almost spend down the entire provider relief fund, but a lot of questions remain, right? The questions remain about what are we doing about the money that wasn't spent, including money that was returned from providers that rejected the funds because they didn't need them at the time. So, the important, why we ask these questions is because absolutely there are ongoing challenges that we're currently facing that, there are a lot of reasons why this provider relief fund needs to keep on helping hospitals with, having cash flow and being able to provide access to care for patients that are still coming in, with variants of COVID. But there's other things that are happening, right? I mean, our world is still different. As I've been talking with providers, and it depends on who you talk to, but there still are issues with patient volume and the acuity of patients. I mean, there's issues of, I've been told that providers preparing budgets for 2022, it's been a really challenging thing because you can't estimate the inpatients coming through the emergency room as maybe once you were able to. We're still dealing with patients that have pent-up healthcare, right? Patients that are coming through requiring more costly treatment because, right, there has been less activity and patients getting more routine procedures done. Also, and I know this is highly discussed, what's going on with labor, right? That hasn't smoothed itself out yet. Not only, and I couldn't imagine being, someone that's treating a lot of these patients. It has to wear a person down, and we're seeing that, right? That nurses and other folks providing patient care are moving on, pursuing different careers or different areas of healthcare, leaving providers, right, with decisions to make on outsourcing and using contract labor, traveling nurses, and those things, which are still super expensive, right? And so these are the stranded costs that a lot of you guys will talk about. What are we going to do about this stuff going forward, right? But in the meantime, how do we sustain operations? The other thing that's happening, right, is the accelerated and advanced payment recoupment. The first 11 months, right, where that recoupment was based on a 25% payback. Now that percentage is about to go up, or has gone up to 50%, right, as for the next 6 months of that payback of those payments. And so that's going to be a challenge for providers. Also very important, and I've seen this in terms of looking at, the interim rates that have been going out to providers, that the Medicare rates have gone down because acuities have changed, because bad debt populations have changed. And so as Medicare, we look at the Medicare rate, which includes like uncompensated care dish. I mean, that took, due to COVID, a huge hit, right? And so all of these things, this is what was stable revenue or predictable revenue in the past, especially from Medicare, which sets the bar, is no longer as predictable, right? And that is very challenging. And obviously with Omicron, and the fact that these new variants of COVID tend to pop up, right? This is very hard to predict, but there's no doubt that there's an ongoing need for additional provider relief. If you all probably know within your own healthcare and medical centers and hospitals, what's going on with your revenue, right? And so some of the things that have been reported back to us have been, well, yeah, we had revenue loss that phase 4 covered. If the phase 4 payment covered revenue loss effectively through 2021 quarter one, but that didn't stop, right? And so we'll talk about, right, well, the impact of that revenue loss and how a provider might be reimbursed, but the money is kind of thinning out, right? And so there's a great need in asking the Congress for additional relief, which is what has actually happened. On January 20th, HAA made an announcement and made it public, effectively what their letter to Congress is, what they're asking for. And so just to kind of cover what that is, notice, distribute, and account for the remaining funds of the PRF, right? So try to let's just put a spreadsheet together and follow the math. That would be nice, right? We need to see that. We're trying to do it. We just did it on slide 2 or whatever. They're asking for another 25 billion, which is a supplemental fund, and it sounds like that the 25 billion would be, again, for focused on those providers, just like phase 3 and phase 4, that have ongoing operation losses as compared to the base year of 2019, right? And so addressing that with another 25 billion would definitely be helpful to providers, especially as the fundings have changed, right? When last year, if you remember, we had some general funds, but then we had these targeted funds for safety nets and high impact and rural. Now we seem to be back into, well, this funding is available, and I'm not saying this is a bad idea, but it just has changed, right? The dynamic of how the money is being paid out to hospitals, that now it's really just focused on losses in operating income revenue, right? And not so much drawing a line saying, well, you're a safety net and you're a rural hospital and you've had X amount of COVID patients. It seems like those types of targets, I haven't seen too much discussion on them going forward, and potentially because as much as providers appreciated those fundings, drawing a line in the sand and telling someone you're a safety net, you're not, you're rural, you're not, you provided a certain amount of COVID treatment to COVID patients, but you didn't provide enough, was dangerous in a way, right? Because these are cliffs where providers right at the edge of those cliffs are still financially impacted but not receiving the funding. The other ask through HA is to extend the relief on the sequester, the 2% Medicare reduction. So we hope that happens. We talked about, right, that the payments for the accelerated and advanced payments are about to go up from 25% to 50% collection. And now what HAA is saying, oh, look, let's suspend that. And when we bring it back, let's bring it back at 25%. All right, let's with everything that's happened, we need to really ease ourselves into this thing. And then I really like this one. And you can even expand this if you're a teaching hospital and other areas of the Medicare reimbursement program that qualify you for certain payment programs. What's highlighted is 340B, and I think it's very wise, right? Providers should not lose 340B eligibility because of COVID-19 and the change in their days and their Medicaid population. I would even say, again, providers shouldn't be penalized for what might happen with bed counts if you're a teaching hospital, right? And that side, and providers technically, and Toyon is actually speaking at Health Lawyers this year. And what we're going to talk about is, well, what do we do about UC Dish, right? We're going to have some information on charity care and uncompensated care before and during COVID. And obviously there's going to be a difference between those providers that operated in states with mandated shutdowns and those providers that did not, right? And what's the financial impact of that? I think there's a lot of things that need to be thought out as we look at the future of provider funding. So Speaking of provider funding, let's see if any, let me just check the questions, see if I have anything here. Okay, no, good. So these are the recent funding pools that I imagine you guys are aware of, right? So going from left, or what I believe is, I know it's my left, I don't know if it's your left, but going from the Rural American Rescue Plan through phase 3 to phase 4, right? So back, I think it was December, the American Rescue Plan funding was started to go out. We have some, we'll talk about in a slide about, well, it's not really funding from the CARES Provider Relief Fund, but just know that everything that's been put out, although it's not from the Provider Relief Fund, it's really going to be treated like provider relief funding in terms of how you report on it, how you attest to it, and significantly, this funding is really limited in the ability to share across TINs. You can't do that, right? It has to stay with the TIN that it received. What's interesting about the American Rescue Plan funding is, again, and this kind of dovetails from, we just talked about, well, we had these targeted funds over a year ago, right? That really address rural hospitals, safety net, and so forth. Now what HHS is saying, right? And maybe because they don't want to limit providers, they don't want to create a cliff, right? For that qualifies or doesn't qualify providers, everybody gets a piece. And that's, I'm not going to, be non-diplomatic about this, but what happens is when everybody qualifies, right, funding is less, right, for some of the more large hospitals and other providers. And so what has been told to us is that, well, HRSA is going to basically take a provider's Medicaid, rural Medicaid claims from patients that live in rural areas and reprice those at, what I think they're trying to say is it's at a standard Medicare rate. In other words, I don't believe that they looked at provider A, determined what provider A gets from Medicare and what provider A gets from Medicaid. I think what they did was they said, well, generally Medicare pays X amount over Medicaid, and that's, that's going to be the supplement. But ultimately, when that happened, right, and generally, when I think about the difference between Medicare and Medicaid, and when I was in New Jersey doing provider advocacy, I mean, the common discussion was, well, Medicare tries to pay cost, right? So if we say that Medicare pays cost, although we know it doesn't pay 100%, but if we said that, then, Medicaid pays about 70% of costs. And that was a New Jersey talking point, but, I've seen it used in other areas. So where I'm bringing this back to is, well, if 30% is the differential, what just happened in the rural fund is you got 3%. Right? A 3% bump. So it goes to show that the intent is to definitely recognize providers that are providing care to rural Medicaid patients. But the funding, unfortunately, I'm not going to say it didn't go very far, because maybe for some hospitals it was meaningful, but for other hospitals and other providers, right, wasn't as much as was anticipated. So like I said, there is a redetermination process for rural rescue plan payments. I think that is an interesting notion. Again, like I said, I wonder if providers can actually challenge the claims that were used. I don't think so, right? Because to HHS, they really, if you want to challenge something, they just want to say, you have to find an error in their calculation, right? Not so much in the data that might have been provided to them. And again, we know, right? I can almost guarantee if a provider said, well, I challenge my Medicaid claims that were used, you would win. I mean, if you've been through a Medicaid audit, especially involving managed care, whether it's through like the Myers and Stoff or Dish Cap audits, that's the whole reason, even in California's quality assurance fee, right? The whole purpose of making sure your payments are good before they're used for payment is because we know that the data that comes from Medicaid managed care plans and sometimes Medicaid fee for service isn't solid, right? And so that obviously is going to be an issue if folks are challenging the claims that were used. So for phase 3, so that's the Rescue Plan Act or Recovery Plan. Phase 3 is, at this point, it's about the redetermination. Now, one of the things I want to cover in the presentation is the relationship between phase 3 and phase 4, right? I think that, the deadline has passed for providers to ask for a phase 3 determination, but as you look at your potential phase 4 payment, you still need to recognize what may or may not have happened in phase 3. And we have a slide that we'll go through with an illustration of that. But the difference between phase 3 and phase 4 is really, we'll talk about this too, but the amount of funding that was weighted in phase 3, providers were eligible for 88% of their losses, 2 quarters, right, of losses, Q 2020 and Q1 2020 and Q2 2020. In phase 3, or phase 4, I should say, providers, there's an extra quarter, right? It's Q3 and 4 of 2020 plus Q1 of 21. But now that a large provider is eligible for 20% of the amount instead of 88%, right? The one other big factor, though, is in phase 3, this is where if you submit an application, right, that you were eligible to 88% of your losses, but that was offset by all the provider relief funding you've received up to that point. Whereas phase 4, there's a carryover of whatever residual. And again, we'll talk about that, but it is important. The big news with phase 4 is that, $2 billion was released this week. And so, I don't know if HRSA notified all recipients yet, but I know a lot of folks are on the lookout for that funding this week. Now, also, the commonality between phase 4 and the rural payments from the American Rescue Plan is how the claims portion was done. So in phase 4, right, very similar to rural, except these are all patients, not just rural patients. Those providers that qualified for a phase 4 payment, they had their Medicaid and CHIP claims repriced, just like in the American Rescue Plan Act, except these are all claims and not rural, right? And so we've tried, again, I think we're gonna learn more about it, hopefully as HRSA becomes more transparent in their formula. But based on reviewing some amounts that were received by providers, currently we estimate that bonus payment is a 1% increase of Medicaid net patient service revenue, inpatient, outpatient, fee-for-service managed care, for claims 1/1/19 through 9/30 of 2020. The other, I guess, we earlier, we talked about, sorry guys, we talked about the, just kind of finishing up what I'll say that the American Recovery Plan rural payments is that, they are different, right? They're not a part of the CARES Act, right? But there's language that are in the terms and conditions that is similar, right, to the other language for other funding as part of the CARES Act. But then there's some language that's different. So I just want to highlight for you guys, so we can see what those amounts are. So what's similar? Well, when you receive, or if you've received funding from the American Rescue Plan, that those amounts have to be recognized with healthcare expenses and lost revenues, just like everything else that we've been receiving, right? So it seems to me that that's going to be reported in the portal, very similar to how we reported in reporting period 1. And they even say the recipient must register this in the portal and submit reports as specified. And what's interesting is then they say, and this is what's different, they're going to specify this stuff in future program instructions directed to all recipients. So we'll see what that says, but the feel of it so far is that it's very much like the Provider Relief Fund payments and how you'll be reporting on these amounts. This, though, is definitely more strict, and this is not in the other language in the terms and conditions. You cannot transfer or allocate this payment to an entity not associated with the subsidiary or billing TIN, right? And so I think that that's important because a lot of folks think about this stuff as, well, what about, is it done on my my Medicare provider number? It doesn't appear so, right? Although that we know that the Medicare provider number and Medicaid number is ultimately what's used to kind of grab all the claims and make payments, they limit it to TIN still. So if that changes, I think that would be an important change, but for now it's limited to your TIN. Phase 3 and phase 4. So like we said, the major difference here, and again, this is where, unfortunately many providers were hopeful for more funding than they've received from phase 4, and some providers are still waiting on phase 4. And the reason for some of these changes is laid out here, like we said earlier too, that any provider that was eligible for a phase 3 payment got 88% of that amount, but that amount was offset by a pretty sizable provider relief. And I see a question here, and I'll get that, and thank you. I'll answer your question in 1 second. I appreciate that question. In phase 4, right, what they did is they said, okay, well, now we're going to, and again, a lot of the communication that has come out by HHS is really focused on their consideration of providers that are smaller and tend to operate under tighter margins, right? Although they, and I'm not going to say I would challenge that, but there was not a lot to back that up other than that statement. So what they've done is they said, if you're a small hospital, and again, these are arbitrary, I'll call it, in terms of just where they drew the line, but less than 10 million, we're eligible to 45% of phase 4 losses. Medium hospitals between 10 and 100 million, 25%, and greater or equal than 100 million at 20%. And so this is where, obviously there's a stark difference between what happened in phase 3 versus the payment payout in phase 4. And again, I think that the intent of phase 4 was then to say, well, we're going to make up for a lot of this based on the bonus. So it really depends on the size of a provider's Medicaid population, but ultimately that adds up to what we've calculated so far, like a 1% add-on. I do see a question, so I want to get to the question. Yes, thank you. PRF period 1 included 6 quarters, and PRF period 2 includes 8 quarters. Yes, you were right. So when we input our expenses, are we only to include the incremental, even if the incremental is spread across? Yes, you're allowed, and I have a slide on this, and it's a great question. You are allowed to report expenses for the entire period of availability in period 2. And we're going to talk about this, but I don't mind addressing it now. As long as any of those expenses were not already reported in period 1. So you just can't duplicate it, but you can absolutely still report expenses from 2020 Q1 through December 31st, Q4 right now. Okay, so let's keep going here and let's look at an example, right, of some of the how the math in this is about math. It's about this, and the reason this is set up the way it is too is to help folks identify if you're looking to potentially file for a reconsideration. Yes, you will receive the slide. Absolutely not. Thank you. And so what we want to identify is what's the relationship between phase 3 and phase 4, because there is one, right? So under this example, right, the provider in both periods, phase 3 and 4, although you could see phase 3 is a comparison of 2 periods, phase 4 is a comparison of 3 periods, right? It's a $10 million loss in both cases. I also want to point out that unlike the provider relief portal, right, when you go and report on being eligible to receive these funds, you don't wipe out any gains with 0, right? Phase 4 is looking at the total, and phase 3, the total change in operating income as compared to the base year. And unlike the portal, which if you've had an increase, it wipes it out to 0, it doesn't do that in the phase 3 and phase 4 calculation. So in phase 3, in this case, provider had an adjusted $8.8 million in losses. So that's a 10 million, right? And here's the eligible percentage. But in this case, right, this was the first payment that recognized what I'll call this change in operating income. And so, therefore, they had to net out any other general and targeted provider relief funding that was received, right? So in this case, the provider received $10 million of PRF and therefore was not eligible for a phase 3 payment, right? In fact, the PRF exceeded the provider's losses by 1.2 million. Whereas you go to phase 4, right, it's the same $10 million in losses. And now, though, the provider is only eligible for 2 million because it's, in this case, it's a large provider. But in this case, too, there was no other PRF that came through, right? This provider hadn't been paid since phase 3. And so in this case, there's no PRF to offset. So you're still left with the $2 million in adjusted losses. But the carryover, right? This is what HRSA is saying they're doing. They're taking all the excess from phase 3 and they're applying it to phase 4. So although the provider was eligible for $2 million in payments, there was excess PRF from phase 3 at 1.2. So the provider's base payment was ultimately $800,000. This kind of presents a few different questions, right? One, what if the provider didn't submit a phase 3 application, right? Did HRSA assume to just bring over the 10 million? And we have an example slide on that. And two, at what point does the provider qualify for the bonus payment, right? So in the event that, let's even say that this was a $2 million loss, but there was, let's say that instead of $1.2 million here, this amount was $3 million, then the provider wouldn't be eligible for a base payment, but still had a loss, right? So would HRSA still provide a bonus payment to those providers? And I bring this up because, as folks are thinking about potential options for a reconsideration, to me, the relationship of what happened in phase 3 and carried forward into phase 4 is a very important part of that. And an area mathematically perhaps can be corrected. I could see some issues being done. So just to, I'm not, I realize, well, we have time, but I want to make sure we get to everything. This is a similar example, right? So, and I'm just really just trying to point out again, right? If the provider didn't receive anything, and had $1.2 million to carry forward in phase 3, right? Well, that depends on whether or not the provider filed a phase 3 application. If the provider didn't file a phase 3 application, and we haven't verified this, but it seems that's what HRSA is doing, they would offset the entire $10 million, right? So in this case, the provider might have said in phase 3, well, look, I know I have a loss, but I understand that my loss is going to be net of my PRF, so I'm not going to file an application. What good is it for me, right? Because at that time, HRSA didn't say, well, hey, you got to file a phase 3, and even if you don't qualify, we need this information for the carry forward into phase 4. That never happened, okay? So, again, if you feel like you fit within this box, this is an area I would look. Because again, in this case, if the provider had these losses, but PRF in excess of losses in phase 3 and did not file an application, it's possible, because HRSA doesn't know what the losses were in phase 3. It's possible that HRSA brought over the entire $10 million, and therefore the phase 4 losses of $2 million were offset of PRF payments of 10, so the provider didn't qualify for a phase 4 payment. Whereas if the provider did in fact submit a phase 3 application, HRSA would know to bring over the residual 1.2 and qualify the provider for $800,000 in payment. So just something to think about, and again, even if you didn't submit a phase 3 application, but are submitting a phase 4 and are waiting on phase 4, you might be interested in, well, what would that carryover be if I did submit a phase 3 application? I see a question. If all quarters changed added to a gain, then the payout would be 0. Correct. If there are gains, right, then this is a non-issue for providers with gains. Good question. Okay, so the other thing to think about is when it comes to potential redetermination or looking at how your phase 3 and 4 payments were made. And again, this is just for hospitals. There are separate thresholds for other types of providers, but for acute care providers, there's a few things. The one I'll highlight is the second, right? So what they do is when you submit the applications, HRSA calculates a loss ratio, which is equal to all of your losses for whatever respective periods you're looking at. We call those quarterly losses, divided by your annual net patient care revenue. And so for any provider in phase 3 that had a loss ratio greater than 11.17%, which is the mean plus 1 standard deviation, it's very possible that HRSA adjusted your losses using this percentage, 11.17%. So again, as you might be looking at, not even for just phase 3, but they're going to do something similar for phase 4. Although what they told us in phase 4 is that they're going to try to work closely with providers to resolve these issues so that no adjustment is necessary. That's not what happened in phase 3, right? And so for anybody that's, again, challenging phase 3 or looking for clarification, you might be interested in that. One other thing here I'll just point out is there's another flag. If any revenue or expense amount in a particular quarter is greater than 50% of annual net patient service revenue, they adjusted for that. But in our review of some information, we didn't see too many of those instances. Okie doke. So we did talk, so again, just so folks know about the redetermination, February 1st, something's going to open and it's going to be open for at least 45 days. It's subject to the availability of funding. The other thing is, yeah, it's going to open February 1st, but that's for the providers that were what I'll call paid to date. There are going to be more payments coming out in February as well. So this could end up being a staggered process. So I guess stay tuned on that. And I think it's important, right? So what we just identified is, well, we're not talking so much if you're challenging phase 3 or 4 about, challenging their methodology or policy. Absolutely not. We're not challenging your methodology or policy. We're just trying to make sure it's correct, right? So, as you're thinking about that in terms of, well, is it mathematically correct? Again, that relationship phase 3 to phase 4 is important. So are the trims. And so is perhaps what the provider submitted as patient care revenue, if there is any more clarity on what those amounts represent. I would still ask about that. So you'll also see that in phase 4, there's minimum documentation that's going to be required. One of the things in here is an email from HRSA communicating the payment determination for reconsideration. So it seems to me that they're only asking for reconsideration if you receive the payment and disagree with your payment. But for those that are awaiting a payment, I still think you reach out to HRSA and basically say, at what point can I challenge it, right? Because you don't want to not receive a payment, but then not be notified that you can't challenge that. Okay, with folks kind of closing up the year and things, and even into next year, there's been some questions on when you could recognize this type of revenue. Between FASB and the Great Gatsby, it's effectively at the point in time the provider believes it has expenses and lost revenues to cover the amount of PRF received. And so there's some references here for you, so that you all can cite that if necessary. All right, so now we're departing from the recent payments and getting into what's going on for the reporting period 2. Excuse me. Make sure I move chats. Okay. All right. So we're 63 days or something like that away from the March 31st deadline. We should be clear again that that represents provider relief funding that came in July 1 of 2020 through December 31st of 2020. And again, a lot of that I think are going to be providers that receive targeted payments, right? Which we're going to talk about, some options you might have there. The period of availability, this to me is so key, right? And it goes back to some questions we already received. And, again, this is so central to every provider relieving funding. It always starts with January 1st, right? The period of meaning that you can apply expenses and lost revenues going back to January 1st now through December 31st of 2021. You just can't duplicate anything that was already submitted in period 1, right? And I'm going to cite that in a second in some examples that HRSA provided. And in fact, let's just do that right now. So there are a number of areas that talk about what we call the carry forward, right? Carry forward of, it's really lost revenues from period 1 into period 2. The reason I didn't say expenses, right, is because, when you were in the portal for period 1, it didn't even let you compute the expenses once you got to the point of PRF. In other words, once your expenses matched PRF, it was done, right? So it's obvious you can bring those same expenses into reporting period 2. But HRSA does provide some good examples when it comes to the carry forward, which are relieving. It's nice to see these. So in this case, this is in the lost revenues guide, and it's cited here. This is a good thing for you folks to have in your resources. It talks about a provider that had $10 million in losses per quarter starting in calendar year 2020 and through Q2 of calendar year 2021. And what it says is, and it just says, if the provider did not already imply, because when you add up all these losses, it's 60 million, right? Between 2020 losses and 21 losses. And so it says if the provider did not already apply the 60 million to payments in RP1, the provider will be able to apply the remaining unreimbursed lost revenues to payments received and not used on expenses in reporting period 2. So to me, there's a nice concrete example supporting the carry forward of lost revenue not applied in period 1 into period 2. When we talk about lost revenues, not a lot. The options providers hasn't changed, but you can change which one you picked in your reporting period 2. But it's still, actual losses, actual to budget losses, and then the alternative. And I'll say just this, working with providers and a number of folks, a lot of folks, even regardless of the increased likelihood of audit under the alternative approach, have gone that path. And really it's because it's, healthcare is complicated. And it's hard for someone to say, well, here's my revenue in 19 and here's my revenue in 20, and without it saying, well, it's not apples to apples. There's always going to be things that skew revenue, especially at a hospital, right? So that revenue is not usually going to be apples to apples between 19 and 20. And so that's gotten people down the path of filing for an alternative approach. And I'm in favor of that approach, also because you're allowed to provide HRSA with a narrative and supporting work papers, whereas in these other approaches, you're just punching in numbers, right? So, like we talked about in the beginning, right? Audits are going to happen. And, I think that, the most important thing with these audits is having a good set of work papers and justification as to why you are accounting for the PRF in the way that you are. But what you can do this go around is you can switch, right? If you want to change the method of how you're reporting your lost revenue, providers are allowed to switch the method and the calculation, I'll say, right? And so just, this is a flag. This would cause, I think, HRSA to want to poke around and see what happened. But you can, if you reported on actual losses in period 1 and want to use an alternative approach in period 2, you can do that. And so that's an important thing to note. My understanding, though, is anything that's computed from a change would only affect period 2. I don't believe that any changes would retroactively go back and affect the comparison of losses to PRF in period 1. This seems like a period 2 and forward opportunity. And so why would someone want to do that? And we talked about apples to apples. I think the biggest, nebulous thing that's out there when it comes to how we account for net patient service revenue is certainly when we think about cost-based reimbursement, when we think about Medicaid and DISH settlements and things. And I've seen different variations of how providers are tackling that. And I haven't received any arguments from, auditors or anybody of any other opinion, where some providers, they make the decision that says, look, I want to make sure I want to keep my revenue apples to apples. So I'm not reporting these programs that pay me intermittently and settle up with me, like some of the DISH programs might, have a huge settlement in the current year that's related to the state fiscal year from 2 years prior. So in some cases, providers are just reporting those amounts as zero. In other cases, which is far more burdensome and sophisticated, providers are realigning those payments so that when they're taking the settlement revenue and they're moving it to the state fiscal year in which it's applicable to, right? As a for instance. So, just again, if you find yourself in a situation where you're trying to think about how to compliantly report this information, but to also make sure that it recognizes, the real story, what's happened at your hospital. This might be something to look at if you haven't looked at it yet, in terms of how you consider net patient care and what it means to your operating losses. Okay, so another thing that's complicated that's happening, right, is this relationship between parent and subsidiaries with payments. So we'll just take the general payments off the side. That's not easy, but you're allowed to transfer, right? There's no issue anywhere from your ability to take general payments and either transfer them to from parent subsidiary. Targeted payments is, I wish different languages used. I wish that HRSA provided us with an example. But what they say is interesting, right? And I think a lot of folks know this, but I guess a good thing to call out too is now they have a fact sheet they put together, because maybe HRSA understands that this is complicated, convoluted as well. So a parent, right, cannot report on a so if a subsidiary receives a fund, that whoever receives that fund has to report on it, right? But you can still transfer it. So what does that mean? How do you report on something and transfer it? So let's take a look at one example that we put together. And again, this is not the only way to do it, right? I think that there's a lot of smart people in our industry that have come up with other ways, and I wouldn't dispute any other way. But the way that I tend to think about this is, okay, so if a subsidiary received a $5 million targeted payment, right, and wants to report on that payment, but transfer it back to the parent, well, how would that happen? Well, in this case, right, so this is before the transfer, right? You can see the $5 million in payments. You could see the general payment, right? Total PRF. There's no other funding in this scenario yet. And other funding means, other funding that reduces COVID-19 expenses that you might have received from other sources like FEMA. And then you have your expenses net of other PRF, because remember, that's when you report expenses, you have to reduce them by any other funding sources. So in this case, in order for the provider to report on the 5 million, but still transfer the money, the subsidiary is going to report that the $5 million, right, as a COVID-19 expense that it allocated to the parent company, whereas when the parent company receives that funding, it's treated as an other source of funding so that nothing is duplicated and the expenses are reduced from the parent company by the 5 million. So this is one mechanism that has been out there that providers may have used. And again, I mean, we're kind of forced into putting together these examples because unfortunately, although, HRSA's guidance is out there, they haven't provided us with an example. So, it goes back to good supporting work papers, pointing to the language and your understanding of the language used for the instructions that, at the time of audit, you could walk someone through. Okay. The other thing that's happening, and again, I think that this is going to be unfortunately complicated for some providers, hopefully not too many of you, but there's scenarios where provider received general funds in PRF reporting period 1 under the parent TIN. But then the allocations that came out for period 2 were targeted funds under the subsidiary TIN. So now, right, this provider or this system is going to have to account for the targeted funding, not under the parent TIN, but under the subsidiary TIN, using some transfer like we just talked about. But the one important piece of this, though, is, well, you have to also account for that carry forward, right? Because, no doubt in many cases, when the parent company reported under its general funds, there was a residual amount of lost revenue, or perhaps expenses, but in this case, we could just say lost revenue that needs to be carried forward into period 2. So that lost revenue is going to have to somehow be allocated to those subsidiary TINs as a part of justification of the period 2 PRF or targeted in one case, right? So that's just something to think about as the funding kind of goes for different purposes, or how it comes into a provider that has the relationship of parent and subsidiary TINs. Okay, so going back to the question that came up earlier, and I'm glad that question came up. We have a couple scenarios that I just want to show you in terms of what's the relationship between reporting period 1 and 2. In this case, right, in reporting period 1, you could see that this provider had $500,000 of losses through the entire period of availability, totaling $3 million in, expenses, not losses. The provider also had $2 million in quarterly losses to report as lost revenue. So the way that the formula works is you in reporting period 1, the provider had total payment, a general payment in this case of $11 million. So the first thing that happens is the provider reduces that 11 million by its COVID-19 expenses. So you have $8 million left. Out of that $8 million, there is a total of 12, right? So now there's $4 million that effectively carry over from RP1 to RP2 within the lost revenue. And you can kind of see it's really these 2 quarters right here. We only needed 8 from each of these quarters, and these 2, right, is carried forward in reporting period 2. So in reporting period 2, because the provider already reported all of its expenses in the period of availability from reporting period 1, there's nothing to report for these quarters, but there's 500,000 from the remaining quarters that are applicable to reporting period 2. So in this case, the provider now has a targeted payment of 7 million, has $1 million of expenses, 6 million residual. Now there's $8 million of losses, right? Four of which really carried over from reporting period 1. And so there is $2 million that the provider is going to carry forward when it's time to report on reporting period 3. So this is when a provider is what I'll call a cut and dry approach, right? Nothing really new has happened. There's a carryover that needs to be considered. Whereas, to address the question from earlier, absolutely. If there are additional expenses being identified that are applicable going all the way back to quarter 1 of 2020, those can be reported. So in this case, right, it's the same $500,000 of expenses in reporting period 1. It's the same $12 million of losses, and it's the same $4 million of carryover. But now the provider is saying, oh man, you know, I had this other cost. It wasn't in my COVID-19 cost center or what have you, but I can identify it and I can support it. So now there is an additional $100,000 of expenses. So now, absolutely, you could report the total of those expenses going all the way back to quarter 1 of 2020 against the targeted payment of 7 million, right? And now there is that same 8 million of carryover from lost revenue. Now there's 2.8 million to carry forward into reporting period 3. So hopefully that was helpful, because I do know that's a big issue for folks, especially as folks get a further understanding of allowable expenses or collect the information, have better work papers, whatever the case may be. And so as we wrap up, just some other observations from all this stuff is just know in reporting period 2, some of the data is going to pre-populate for you, but your expenses will not pre-populate. Your lost revenue will only pre-populate if you don't want to change what you reported on the first go around. As we think about the need for future funding in the Provider Relief Fund, do recall that there's an area that you could fill out for reporting unreimbursed expenses. That's an area where you might say, look, I don't know if I could support all this with a receipt, and all the things that an auditor would look for, but I know that these are real expenses to me, maybe excessive length of stay. That could be a good place to populate that, just to simply say, we need to recognize all these costs, because going forward, we're going to need some more support. And also the other thing is, as you all are looking at reporting those expenses, just know one of the other things that has happened is, that this whole bit where you have to reduce your expenses by other sources of lost revenue is definitely complicated. And what I'd say is that's only necessary if those other sources of payment aren't being accounted for in the lost revenue calculation. In other words, I don't believe that other payment sources need to be accounted for twice. If they're affecting your lost revenue calculation, that should be enough. And like we've been saying throughout the presentation, solid work papers are the key for this. I think we're all trying to do our best and understand the mechanics, what's allowable, not allowable, but at the end of the day, we're subject to FAQs and our interpretation of FAQs. And so the ability to articulate what you're doing and quantify it within neat and organized work papers, I think will go a very long way, as these audits start to happen. You see a question. Are we allowed to correct prior claims? What if we need to go back out some ineligible? So good question. And what I would say there is, I guess I'd have to know a little bit more about what the other variables are, but I guess the way I would think about it is I would go, if I was uncomfortable with something reported in period 1, in period 2, I would apply a reversal and back out that expense and just basically have it reflected in period 2. But that really just depends on the impact it has on what I'll call the overall payment received to the hospital. I think the way that I would think about it is, as long at the end of the day, the expenses I have in total that I'm comfortable with cover my total PRF, you're good, right? It's just a matter of how you smooth those out and recognize those over each period of availability. Anybody have any, well, before I say that too, there are resources here. So this is all on the CARES website. So it's under reporting period 2. They did a webinar last week or the week before. I didn't see it posted. At some point, their webinar will be posted. And if you want to go poke around and where these payments are coming from, we have resources for that too. So I appreciate all you. Thank you so much for being on this call. Is there a requirement for interest? Yes, thank you. Love that question. Yes, there is a requirement for interest. It's one of the things that when I was working with providers, I'll be honest, in period 1, it was like, oh yeah, we have to do that, right? And it was pretty de minimis. It wasn't material, but it was still important to identify and make sure that those interest payments were included, because what HHS will do is add them to the total amount of PRF received. So there is a requirement for interest earned. Thank you, Nam. I could wait a minute if anybody else has any other questions. And as always, feel free to email me. We'll make all this presentation accessible through Toyon's website. It's recorded, so it'll be on there as well. But in the meantime, if you want a hard copy of it, just shoot me an email and I will respond with a copy of the presentation. So appreciate everyone very much. Thanks so much for your time today. I hope you all have a great rest of the week, and it's all matter of what's next, right? And so stay tuned, and we'll always continue this education. But thanks so much, everybody. Hope you have a nice day.